morning. Welcome to another 55 minutes of current and relevant business conversation. And it's right here on Business Morning on Channels Television. I'm Ini John Mekwa. Let's start off. And we start off with oil prices. There was a little change on Thursday, looking at uncertainty over whether the United States will avoid a debt default weighed against the prospect of further OPEC Plus cuts. Brent crude futures eased 1 cent to $78.35 a barrel, while U.S. West Texas Intermediate crude fell 11 cents, that's 0.2%, to $74.23 a barrel. Well, some progress seems to have been made, but several issues remain unresolved in the U.S. debt ceiling negotiations, House Speaker Kevin McCarthy had said, as the deadline ticks closer to raise the federal government's $31.4 trillion borrowing limit or risk a default. Negotiators for the Democratic President Joe Biden and top congressional Republican Kevin McCarthy reconvened yesterday, Wednesday, at the White House to try to close that deal. Well, in the previous session, oil prices were supported by a warning from Saudi Arabia's energy minister that short sellers betting oil prices will fall should watch out for pain. Well, some investors took that as a signal that OPEC Plus could consider further output cuts at their meeting on June the 4th. Meanwhile, price declines were capped by an unexpected massive fall in U.S. crude oil inventories in the wake to May 11. And U.S. crude inventories fell 12.5 million barrels to 455.2 million barrels as imports declined. Gasoline inventories also dropped by 2.1 million barrels in the week to 216.3 million barrels, while distillate stockpiles fell 600,000 barrels to 105.7 million barrels. Still talking oil now, but this time it's edible oil. Malaysian palm oil futures rose on Thursday for a second consecutive day, lifted by a weakening ringgit, although estimates of rising production and weak demand capped the gains. The benchmark palm oil contracts for August delivery on the Bursa Malaysia Derivatives Exchange gained 27 ringgit to 3,434 ringgit, or $774.03 a ton in early trade. The ringgit fell 0.54% against the dollar to its lowest since November 2022, making the commodity cheaper for buyers holding foreign currency. Cargo surveyors are scheduled to release May 1st to 25th shipment data later on today, and traders say demand has been subdued so far this month amid industry surveys indicating rising production. Now let's see what's happening with grains. Chicago soybean futures slid on Thursday, while corn was largely unchanged as lack of demand for both commodities amid bumper global supplies weighed on price. Wheat lost more ground, falling for a second straight session. Demand for corn and soybeans is not picking up at a time when the global supply picture is improving. The most active soybean contracts on the Chicago Board of Trade lost 0.2% to $13.22 a bushel, while corn was unmoved at $5.87 for a quarter of a bushel. Wheat gave up 0.1% to $6.05 for half a bushel, having lost 2.6% on Wednesday. The dollar also hit a 2-month high against the basket of pears on Wednesday, bolstered by recent signs of resilient U.S. economy, while unease over U.S. debt ceiling talks kept investors moving to safe havens. Dismissal demand for corn and soybeans from top importer China is providing headwinds to prices. Yesterday was decision day for Nigeria's MPC, and we had that meeting ready to you live. But now let's capture some of the high points of that announcement after a 2-day meeting, the third in this year for the MPC of the Central Bank of Nigeria.
Yeah. This is the last Monetary Policy Committee meeting under the administration of President Muhammadu Buhari, and it's coming at a time when inflation, high debt burden, and poor crude oil output is hitting global economies, and Nigeria is not left out.
The kind of benefit we're even seeing today with what we call a somewhat moderated growth is even the result of some of the interventions that were done in the past. We are not entirely going out, but we are not going to be aggressive, because by remaining aggressive in that direction, certainly what it does again further is that it blunts the efficacy of our policy in this direction of trying to rein in inflation. So it's a balancing act, and we just pray and hope that people understand where we're coming from.
To guard against the shocks experienced and their impact on the nation, the Central Bank of Nigeria highlights the bank's intervention in key sectors of the economy. The figure now stands at 2.56 trillion naira. The Monetary Policy Committee jerks up the interest rate to 18.5%, and other parameters were left unchanged.
What we said is that
the central bank governor then explains that the increase in the interest rate is expected to lead to a downward trend in inflation, but he is, however, concerned about the nation's crude oil production.
We need to be able to ramp up production effectively to 1.8 minimum. Plus condensate, we need to plug 2 or 2.3 million barrels per day. If we do not do this, I think that we are really looking at real problem ahead of us. Particularly at a time when there is a concerted determination to exit the subsidy regime. There is danger ahead.
The bank expects the Nigerian economy to receive some boost following the interventions, which run into trillions of naira. The Apex Bank hopes to continue to find ways to control all inflationary indices, as well as reduce the sufferings faced by Nigerians.
That obviously will be one of the conversations to be having. Interest rates, the MPR has been raised now to 18.5%. What can we expect following that? So we'll be having that conversation. But just before we go there, the African Development Bank has been meeting in Cairo, Egypt. And one of the topics there, a major one, according to the president, Dr. Akinwumi Adesina, is developed nations not honoring $100 billion a year pledge, for climate change. And he believes that a lack of adequate financing for tackling climate change on the continent has become dire and is choking the continent. But let's have joining us from the location, that's Egypt, Professor Kevin Rama is Chief Economist and Vice President for Economic Governance and Knowledge Management with African Development Bank, joins us from Cairo now to bring us up to date on some of the conversations there. Professor Rama, good morning. Thank you for your time this morning.
Good morning. Thank you for having me.
So the president, that's Dr. Akinwumi Adesina, is really, hot on this issue. And he's been talking about global financial architecture that seems to have failed Africa. Help us to understand his perspective to this. Hello, Professor Rama, can you hear me?
Architecture is failing Africa in several ways. If you just home into climate change, which is what we're talking about here, Africa needs about $2.7 trillion to implement climate action between now and 2030. But what Africa is receiving annually is very small compared to what it's supposed to be receiving in order to implement those agreements. So currently, the total, average annual climate financing required by Africa is around $242 billion annually between now and 2030. But Africa is receiving only $18.3 billion. So the financing gap is huge. And we continue to have what the president of the bank called yesterday, megawatts of talk. We have several conferences of parties having discussions and promises. But as Kofi Annan always said, only the promises that are kept are the promises that matter. So that's just a call for the developed countries to honor their commitments under the Paris Agreement, under the climate agreements and other agreements that we have reached, so that they can make available the resources that is supposed to solve this global commons challenge we have on the continent.
So what's this costing Africa? What is the cost in real terms and in sectors and industry? What cost is it to the continent?
The cost of climate change to Africa is huge. As we estimated in our African Economic Outlook report of the year 2022, Africa is already losing 5 to 15% of its GDP per capita growth, gross domestic product per capita growth, because of the impacts of climate change. Changing weather events, floods, droughts, and other cyclones and other things are impacting several parts of the continent. Floods in Nigeria, for example, you will find a lot of damages to property, a lot of damages to lives and livelihoods that needs to be rebuilt with the limited fiscal space that these countries have. And you have different types of those challenges across the continent. And the frequency is also increasing. And as you know, Africa did not cause climate change. We have contributed only about 3% of the CO2 emissions that caused the climate change. But other countries have benefited in their own economic growth by actually emitting climate-forcing emissions that has created the problem. So because climate change is a global commons challenge, it then means that all actors involved need to come together to meet their commitments if we have to save the planet and keep the world going below the thresholds of temperature rises that is expected to become catastrophic for the world if we did not do that. So if you think about cost to lives and livelihoods, just think about 5% of GDP being lost, 15% of GDP being lost in different countries. On average, we are losing between 7 to 15 billion US dollars annually because of climate change-related losses and damages. And this will only continue to grow. And like I've mentioned, we require 2.7 trillion US dollars between now and 2030 to be able to implement the climate agreements that was mutually agreed in Paris during the climate COP in Paris. So it is just that responsibility that is required from every party to ensure that we do not allow countries who have not created the climate change to suffer it more. And think of it, our research also shows that countries that have more impacts of climate change, countries that are more vulnerable to climate change, do not receive climate finance. And that is why the president of the bank is saying, clamoring that climate finance is shortchanging Africa, because climate finance was created in order to help countries to adapt to climate impacts. But our research have shown that countries that are more vulnerable to climate change are actually not receiving these climate finance. And a lot of those vulnerabilities to climate change are in Africa. Thank you.
All right, Professor Kevin Rama, thank you so much for that, Chief Economist and Vice President for Economic Governance and Knowledge Management with African Development Bank. We wish you a success. We wish all of us success. I mean, we're all in Africa here, and we do feel those pinch from climate change. And the loss, I mean, putting the loss as between $7 and $15 billion annually is a huge loss to any continent and country. Thank you so much for your time. Wish you more success in your conversations there.
Thank you so much.
All right, now let's move to our Abuja studio and look at some of those. Yesterday was a huge data day for Nigeria. We had the MPC decision day, and they announced a 50 basis point hike in the MPR, bringing it up to 18.5%. And also later on yesterday, we had the GDP for first quarter for the country also released. It slowed to 2.31%. From 3.52% in the fourth quarter of 2022, went down to 2.31%. And then, of course, like one of the issues or considerations for the MPC yesterday was the issue of FX. We don't seem to be able to run away from that. Let's help get conversation and perspective to this with Dr. Bola Adigun. She's from Deloitte and Touche, partner and head Economic Advisory for West Africa for Deloitte and Touche. She joins us from our Abuja studio. Dr. Adigun, thank you so much for your time this morning. Good morning.
Good morning. Thank you. I hope you can hear me well.
Yes, I can hear you. So we saw the MPC number, the MPR hiked yesterday to 18.5, and it's the highest in 22 years. But I guess it's a normal thing. If inflation is surging, then the rate should be hiked. Even though the CBN governor did take some time yesterday to try to explain that if not because of the hikes, because of course there's been conversation as in how effective are these hikes? You know, we've had this the 7th one now. How effective are they in curbing inflation, since we see inflation continue to increase? And we hear people say, well, the problem in Nigeria is not really the thing with the rate, it's more of the supply. But I mean, how effective, let's get your perspective first. How effective has the rate hike been in curbing inflation in Nigeria?
Okay, so we've experienced multiple hikes in the rate from 16.6 to 17.5 to 18, and yesterday to 18.5. I don't think that the rate hikes have been very effective in curbing inflationary pressures that we are experiencing in the country. Like you rightly pointed out, as at last month, inflation was about 22.2%. We opened January this year at 21.8%. There are multiple factors that are influencing the level of inflation that we have. I don't think hiking the MPR is the way or the solution to this. There are multiple sub-components. So, for example, what exactly is inflation measuring? Inflation is measuring the rate of increase in the prices of goods and services, right? So as a manufacturer, for example, the price at which you sell your product, it's a case of your total cost of production plus a margin. So what is really influencing the inflation? You're looking at energy prices, you're looking at FX spillovers. For example, if you're a manufacturer and you import some of your inputs or some of the components you use in your manufacturing process, you import it. The FX challenges that you are currently experiencing is part of what is influencing your higher cost of production, which is putting additional inflationary pressures in the economy. So the multiple rate hikes from 16.6% to 17.5 to 18 and 18.5 has not been very effective in curbing inflationary pressures that we are experiencing in the country. And there's need to have a further comprehensive overview or review of how the country is going to address inflationary challenges as against hiking the MPR. You need to realize that the MPR is a very critical rate. It's the anchor rate that influences activities both in the money market and in the economy as a whole. So, for example, if you have a loan with the commercial bank and your loan is at 20%, as the CBN increased the rate by 50 basis points yesterday from 18 to 18.5, your cost of debt automatically increases. And what does that mean? It means that your cost of production increases. So by increasing the MPR, you might also be indirectly adding additional inflationary pressures on cost of production.
So, but we didn't hear the CBN governor say that if not because of the hikes, that by now we would have had inflation at about 30, but what are we supposed to do when we look at, you have broken down how inflation is being driven, when it comes to the case with Nigeria. What are we supposed to be doing?
So, basic economics says that the differential between your MPR and your inflation should not be too wide. So what do we mean? If inflation is currently at 22.2% and MPR is at 18.5%, you want that differential to be as minimal as possible. But that does not mean that by hiking the MPR is how you curb the pressures on inflation, because hiking the MPR has both positive and negative consequences. On the positive side, it means that if I put my money in the bank, for example, I invest my money, I should be able to get higher interest rate on my money. On the flip side, it's going to affect businesses, startups, private endeavors, because the cost of borrowing automatically increases. And what that does is increase your rate of default. And it also increases potentially the non-performing loan portfolio of banks, because it means your monthly debt service obligation has automatically increased by the 50 basis point increment the CBN announced yesterday. So I think it's best to look at what are the sub-components of inflation. What is driving the sub-components, and how do we address those sub-components rather than just addressing it at the top level of MPR?
All right, so we also had our GDP yesterday, and we saw it slow just within quarter to quarter from 3.52% to 2.31%. But I guess this shouldn't come as a surprise, because the first quarter of 2023, we had a lot of disruption. We had the cash crunch, we had the petrol scarcity, and a whole lot more squeezing the economy and economic activity. So I guess this drop in the GDP should not come as a surprise.
Absolutely, absolutely. There exists a positive correlation between effective payment method and level of economic activity or level of output. Yes, yesterday it was announced that the GDP growth was 2.3% as against 3.5% the previous quarter. And like you rightly pointed out, Nigeria experienced a lot of pressures in the first quarter. We had the election fever. We had the cash crunch or liquidity challenges that we had. We had the fuel scarcity. I mean, we witnessed massive fuel queues from Lagos to Port Harcourt to Kaduna to the southeast. So all of this impacted on the level of economic activities, and that is what you can then see in the GDP growth rate that was announced yesterday of 2.3%. Where you are trying to implement a cashless policy and the infrastructure to support that cashless policy does not fully exist yet, you have payment supply distortions. And all of that played out in the contraction in economic activities and the slowdown in GDP growth rate to 2.3%.
How do we get out of this? Or do you think, since we do not have the cash crunch, election has come and gone, this quarter, the second quarter, should we expect that, we should hit back our 3% or even at higher than that?
There are multiple factors that can enable us get to 3% and even higher than that. And it is the incoming administration post-swearing in. If, for example, the incoming administration hits the ground running, announces its cabinet, and it puts in the right mix of experienced hands with global recognition or international recognition. You send the right sentiment to the international community that Nigeria is open for business. You provide the right comfort to drive the right sentiment. Then we can start to expect higher GDP growth rate of 3.5 or even more. A critical low-hanging fruit to drive economic activity is foreign direct investments. We've been having decline in the amount of FDIs we have been able to attract into Nigeria. Nigeria needs to be in the position to attract a large percent of whatever money is coming to Africa. And if you have that coming through, and you can accelerate some of these investments into critical sectors in the economy, then we can expect an increase in our GDP growth rate in the next quarter.
All right, so when you say the administration should hit the ground running, what exactly do you mean? What should be the first step, the second, that we should be expecting? Okay, so there are some low-hanging fruits, in my opinion, that I think the administration needs to consider. A very critical one is the subsidy. When you hear numbers of about 3 trillion naira for first quarter just in subsidy payment, it's ridiculous. We do not have the physical and economic capacity to continue to fund subsidy. So there are certain low-hanging fruits that the incoming administration needs to focus on. And one of it is subsidy removal. Another is we need to address our FX problem. Now, the problem we have with FX, where you have Naira depreciating, is your supply-demand imbalance. If you have a lot of demand for FX, for dollars, and you have limited supply, then it means you need to increase the supply of dollars or FX. And what are the four typical culprits for that? Your FX, your crude proceeds. You need to ensure that crude proceeds are as high as possible. Your export proceeds. And then foreign direct investment. And then the fourth of which is diaspora remittances. So if you can increase this amount, right, and you increase the supply of FX, it will sort of reduce the pressure from demand for FX. And then you can have a healthy exchange rate.
So I'd mentioned FX. We need to manage our FX. We need to address subsidy. Another area is debt management. Nigeria has a huge debt overhang, and I mean the incoming administration has its work cut out because we have declining revenue streams that we need to expand. So you need to look at how do you expand your revenue streams. And it's not only by taxes. You need to look at what other revenue generating heads needs to come, the incoming administration needs to consider. So for example, Nigeria is very dependent on oil, right? I mean, 2/3 of government revenues and about 90% of our FX is from crude. When you look at the revenues that we make from crude, two dynamics come to play. It's our production and then the crude prices, right? I think it was announced that we are currently at 1.34 million barrels per day. We've increased from about 1.2 million barrels per day, but we are still shy of the 1.5 million barrels per day that the government is projecting. So if you want to increase your proceeds from FX, I have said the two dynamics are your crude prices and your production. So what are the factors that you need to put in place to ensure that production continues to increase? How do you encourage IOCs and local oil and gas companies to put the right investment to increase production? On the crude prices currently is around $78, $79 per barrel. That's lower than what we had last year. Last year was about $98 per barrel for crude prices. I'm talking about Brent. But you realize that the crude prices currently, they've already priced in the war premium from the Russia-Ukraine war. So if we assume that crude prices will be around $78, $79 per barrel into the next, say, 2-3 quarters, then as a country, we need to find out a way to increase our production so that we're able to increase our proceeds from crude.
All right, Dr. Bola Adigun, thank you so much. Increasing our production is one major thing that Nigeria could do, but it seems difficult because we see our production down again, I think for the second consecutive time in recent times. You are the partner and head economic advisory West Africa with Deloitte and Touche. Thank you so much for your time this morning.
Thank you.
Let's take a break now. When we come back, we'll head straight to commodities. Welcome back to Watching Business Morning here on Channels Television. We head straight into commodities time now with Adesola Sumoni joins us from Reading in the United Kingdom. Hi, Adesola. Good morning. Second time this week. Good to have you on the show.
And thank you for having me on the show.
All right, so let's dive straight into it. Goldman Sachs is projecting stellar performance for commodities. What does that mean? What have they considered? What is this about?
So Goldman Sachs, as everyone knows, they are commodity bulls. They are almost always bullish on commodities, and they see commodities markets perform quite. They forecast that commodities market will perform quite well in the coming 12 months. They look at things like oil, for example. They feel like, the oil market is expected to be undersupplied in the coming half of the year by around 2 million barrels. Even the International Energy Agency also supports that forecast, and the IEA, the International Energy Agency, since November has been revising upwards their outlook for oil demand. Also, we are seeing, the big factor is commodities usually are used for to hedge against uncertainty. For example, if you look at what's going on in the global financial space, we are seeing fragility in the financial sector with banking sector crisis. We are seeing issues around the US debt ceiling. We are seeing issues around recession risks. So in the context of all of these, our commodities are seen as a safe space or as a safe haven for investors. If you look at gold, for example, gold is a commodity that, usually gains value during periods of uncertainty because it is seen as a safe haven commodity. So there's a lot of investment in gold, and this is part of what Goldman Sachs is talking about. We're also seeing for oil, I've said, there's forecast that the market will be undersupplied. There's forecast for strong demand. There's forecast that there's strong compliance to OPEC production cuts, and they expect that to boost oil prices. They even see oil prices at $95 per barrel at the end of this year and around $100 per barrel by spring next year. If you look at natural gas as well, they forecast that even though natural gas prices in Europe are relatively low now compared to this time last year, they expect prices to inch upwards, driven by stocking for the winter, usually many countries stock up on natural gas during the summer so that they can draw on it during the winter. They also see some a strong demand coming out of Asia, particularly China, for industrial manufacturing. So they expect that some of these, natural gas cargoes currently going to Europe might shift towards Asia, and that will boost natural gas prices upward. So all of these factors are what they consider, and that's why they forecast that commodities are a good place to put your money at the moment.
A good place to put your money, but I mean, I was just thinking of the other side, if commodities get more expensive, that means that consumption will be affected. And we're talking of inflation now. So while, for instance, the price of oil increasing is good for a country like Nigeria, because our budget has $75 for a barrel. So if we have more than that, then it's good for us. But when you look at other commodities, when they're performing well, it also has its disadvantages.
Indeed, it does, right? But I think Goldman Sachs is looking at it from an investment point of view, right? So if you put your money now, they forecast, they have this index is what's it called now? S&P GSCI index, and they say, if you put your money in there now, in the next 12 months, you get 30% return. Obviously, there are always going to be winners and losers when commodity prices increase. So I think that's the point of view they're trying to take.
All right, so we can invest and make some money as well as pay more for consumption. But what else is happening in the commodity space? What's happening to especially our staples and stuff like that?
Also, for the domestic commodities, it's a little bit mixed at the moment, to be honest. If you look at commodities like sugar, we are seeing our price up around 20% to 42,000 naira. That's for a 50 kg bag of sugar. We are seeing tomatoes is up 60% to 40,000, and that is mainly because of this a parasite called Tuta absoluta in the grain regions of Nigeria. We've seen that kind of really destroy a lot of tomato farms, and that has reduced supply. That's why we're seeing price inch upwards quite significantly. Also, onions is up 12% to 28,000 naira. But we're also seeing that some positives. We're seeing the bag of rice down 8% to 35,000 naira. We're seeing the bag of beans down 26% to 30,000 naira. We're seeing cement also down 2%, 4,200. Some prices are still also flat. Flour is flat, 28,500. Pepper is also flat at 20,000 naira. Overall, I think the key drivers are for instance, the planting season. We are expecting that some prices are going to trend upwards due to the planting season. We are seeing also Tuta absoluta reduce production of tomatoes, which is pushing prices upwards. And also exchange rate. The weak exchange rate is also having this exchange rate pass-through effect on some commodities with high import content.
All right, Adesola Somoni, thank you so much for that mixed bag of price movement for your time this morning. Dr. Adesola Somoni, Senior Analyst with Financial Derivatives Company, thank you for your time.
Thank you for having me.
Let's see more prices now as we head to the other markets, beginning, I guess, with the equities market, and Will comes in with a green on the board.
Good morning, Nini.
Good morning.
We're seeing yesterday's performance was very bullish.
Yeah, I think this is second in the week.
Second in the week. No, yeah. This is the
third positive in the week.
Positive in the week.
Awesome.
It's been
it's been the bull.
It's been the bull that's been raising, as in like doing its thing. The bull is taking charge of the flow of the exchange.
Yeah.
I don't think the bear can have a say right now.
Oh, please don't be too confident.
So we're seeing domestic investors playing a big one yesterday. All share index rose higher by 0.58%. Market cap, the index is at 52,927 points. Market cap is still at the 28 trillion naira mark, inching closer to 29, and we see that's also going to the 53K level. Now, bullish momentum, we saw that because of bargain hunting in Nestle, which was up about 10% yesterday. Now, we saw also the all-share index, now month-to-date, is in positive territory. It's at about 1.4% now, and we have the year-to-date return also in positive territory, 3.3%. 0.8% respectively. Now, total volume traded increased by about 29.7% to 455.18 million units, while value was at 7.83 billion Naira, and all transacted in 6,635 deals. We're looking at the sectors. We see the oil and gas index up yesterday very strongly by 2.54%. We also see the banking sector and consumer goods sector. Nestle was the big culprit here that drove this index over 2%. We're seeing Total Energies working the magic here, and industrial goods was up. Lafarge was doing his thing there. Insurance was down, the only sole loser for the day. And we're going to bring in Abdulrasheed Momo, his equity trader, TLW Stockbrokers, to give us more insights and tell us why the market is so bullish. Good morning, Abdulrasheed. It's good to have you on the program.
Can you hear me?
Yes, I can hear you loud and clear.
Okay.
Abdulrasheed, bullish momentum. Is this a bull trap? What are we seeing here? Tell us about that.
Yesterday, I actually told you it might be a bull trap. In one case, the good news is that the market, as I said, since April till date, right, the market has been trading within, a tight range of 52,000 points, about 52,600 since April till date. But yesterday, there was a breakout to 52.9, 52,900. I think Nestle and Giregu, were the ones that actually spiked. So, but if you notice, there has been a price war between Zenith and GTB lately, and they were actually within some strong resistance areas, which we saw profit taking. So far, the scenario I'm seeing now is let me explain. The scenario is that we have been trading in this market for some time. We have an idea where prices ought to be and where prices ought to reverse. So what we are seeing is that if this bull trend continues and the retail investors keep taking profit, we might see a scenario where the big players are actually mopping up all those shares and taking it to a next level. So for what I'm seeing so far, when stocks like Zenith and GT start hitting about 13 naira, they will know that it's a different ball game entirely. But for now, yesterday was a breakout. Nestle, once in a while, they come up. But for other indexes, they've done well so far, but we've seen some form of profit taking. The way the market is playing now, the market is actually playing flat. So we need to wait and see if there will be a confirmation of a new trend going upwards.
Okay.
Or perhaps the market will stall.
Okay, well, we'll wait
so it's a 50-50 situation now.
Okay, so in 50-50 situation, while we wait for that confirmation, it doesn't look as if MPC happened yesterday for the equities market. Why the equities market defying or ignoring the MPC decisions, or is there no impact at all? Would there ever be any impact on the equities market?
The market always discounts a lot of things. In anticipation of what's going to happen, market already takes... sometimes the market goes ahead, or at times we might see the after effect. Let me give you an example. Why I knew the market was likely going to be bullish was, if you notice, when the banks were actually paying in, because a lot of companies did very well this year, from 10 to about 15% dividend payout, we saw that rally, and we noticed that when those dividends are paid in, you see a lot of people reinvesting into the market. And the way payments were actually spread out this period, you can see, I think Access Bank was paid yesterday or so. You could see the push in Access Bank. So basically, as long as some of these companies, perhaps when those dividend payouts are actually slow down, when they all paid, then we might not see the true reflection of the market. But as it is, the market for me is still on sales. I mean, how many companies can pay such yields in a year in the world market as we speak today? So Nigerian market is still doing very well. And I feel those stocks are still relatively cheap.
So what do you expect for the market close today? Should we expect this bullish close, or are you going to have a bearish view?
confirmation. The market is flat. Most of the indexes are actually down for today, but the drive is actually minus 0.04. So it's a minimal change. Okay, let me explain in technical terms, right? When the market broke, when the stock breaks in recent levels, what it does that it comes back to test that level. So if the market tests about 52,600 plus and goes up, then we are now in a new bull trend entirely. So for now, I think it's all about caution. Caution. If you've made money, I mean, look at stocks that they've marked down. They marked down most of these banking stocks 2 weeks ago. They've all recovered. The only two that haven't recovered so far, Access and UBA. They've not recovered back to about 11 plus. I think Access is close. UBA is still lagging indicator. And if you see today's statistics, you see that the most traded so far, it's UBA, followed by Access Bank. It's logical. It's easy to actually analyze the market and how it actually goes. I think yesterday we saw some people selling out of Zenith and UBA, and Zenith and GT, and entering UBA and Assets. Yeah.
Okay.
So I think we should still wait. All we just need is a confirmation.
Okay.
If this will be beginning of a new bull trend or not.
Okay. Thank you so much, Abdul Rashid Momo, equity trader at TLW Stockbrokers, for those insights. So any caution he advises. So we should watch the market and see how the trend is. The banking stocks have been the toast. But now one should trade with a bit of caution.
Yeah, well, profit taking will always come and go.
Yes, definitely.
All right, thank you so much, Will. See you at 1:30. Now let's go to London now, where there's a bit of good news, I hope. We hear that annual household energy bill will fall from July, but Juliana is there. She feels this pinch and she has the details. Juliana, good morning.
Good morning, Innie. Yes, you're absolutely right. We have had an announcement this morning from the energy regulator, Ofgem, basically saying that they have lowered the tariff for energy bills, which is going to come into fruition in July. So from July, the typical household will be paying just over £2,000 a year for their energy bills. And so basically at the moment, what we've had since Liz Truss became Prime Minister, of course, she subsequently left that position, but one thing she did successfully do well was put in this energy price guarantee, which limited the amount that your energy provider in this country would be able to charge you. And that was at £2,500 a year. It was only going for about 3 months, but the Chancellor, Jeremy Hunt, extended that. And then, of course, now we've got this announcement by Ofgem saying it's going to be lower than the £2,500 a year at £2,074 a year. This is a welcoming development, and it could potentially save the average household about £400 a year through their energy bills. But once you take away the guaranteed support scheme on top of the cost of living crisis, to be absolutely fair, a lot of economists in Britain this morning saying, although it's a welcoming development, we're not going to see much of a reduction. Particularly because we know we're expecting that there is going to be a cold winter. And we have been hearing from energy bosses throughout this week that they expect there to be a depletion in the amount of energy that Europe does have in the colder months. And so we hold on to the good news, but once you scratch beneath the surface, Innie, and have a closer look at this data, you realise that you're pretty much paying more than you were paying before.
Yeah, I knew you were going to scratch beneath the surface and dig out some of the not so good news surrounding that. But okay, let's see what you do with this surging car production and in the face of high cost of living.
Yeah, that's pretty interesting, actually. We have had data released this morning by the Society of Motor Manufacturers and Traders showing that UK car makers recorded an almost 10% increase in production in April with just over 66,000 cars. We know that the biggest export for UK-produced cars is Europe, and I think it's then followed by Australia, the US, and China. So this is a welcoming development for the car production firms, they're finally motoring on, excuse the pun. And it does come at a pretty critical time for the US car manufacturing industry. We had that warning last week from Stellantis, which is the parent company of car production companies like Vauxhall, who was saying that, they're going to have to leave the UK if rules of origin around Brexit are not changed, because we're not yet ready to build a fully electric car. So I think the fact that production is increasing, and the fact that when Rishi Sunak, the Prime Minister, was in Japan last week for G7, he reassured motoring bosses such as Nissan that the government will be doing whatever it takes to ensure that producers can manufacture here competitively. I think this is good news, and it is going to be safeguarding tens of thousands of manufacturing jobs that, of course, rely solely on UK car production.
Yeah, and I guess eventually to feed into the GDP. But thank you so much, Juliana, it's good news from UK this morning. We'll talk to you at 1:30.
Thank you.
Let's see if there's good news from the crypto space now with Ladi, even though they're still undecided in spite of our MPC decision.
Short answer, no good news yet. At this point.
That was hard and straight.
And really short. Yeah, I know, because it's right now we're seeing major cryptocurrencies losing, major support at this time, turning that support into resistance, at this point. A whole lot of things, affecting this market at this point. U.S. debt ceiling negotiations weighing.
Yeah, the 1st of June is very close.
It's right there. We can see 1st of June. It's right there. And
don't worry, we'll take care of it.
We'll take care of it, right?
Yeah.
Fantastic. And he says we'll take care of the U.S. debt ceiling. Let's look at the top cryptocurrencies we track now. We see Bitcoin there losing that 26,300 level. 1.81% down this morning. Ethereum also losing that 1,835 level, 2.14%, bigger drop than Bitcoin this morning. It's right across board at BNB. We're eyeing that $300 level for the Binance token for the exchange there, 1.18% down. Cardano, 1.23%, and we see XRP not left out, even though they're scoring points against the US SEC at this moment. It's down too, with all the volatility that we see in the market. Let's look at the top gainers counter. We see Sandbox managing to hold above there, 4.03%. Let's bring in Olumide Adesina, our financial market analyst. Hello, Olumide. Good morning.
Good morning, Ladi. Thanks for having me.
Yeah, so it's a bloody market,
very market
this morning. Yeah. What's going on, Olumide? How you seen it?
Well, just like you rightly said, it's been a bit gloomy, in the crypto market and other asset classes, particularly commodities. You could see gold rallying below the 2,000 ounce, and also Bitcoin refusing to break above the 27,000 resistance level. And pretty much, there are a lot of intrigues behind the markets. First of all, the dollar index is rallying at its monthly highs, despite the fact that the US debt limit and the Fitch rating agencies downgraded US debt assets. But still at that, investors are really keen that the Republicans and the Joe Biden administration will put things in order. So that has really put liquidity crunch across risk assets, particularly in the crypto market. And you could see altcoins dragging down and the crypto market valuation above 1 trillion. But having said that, also you need to look at the effect of regulators and scam. The recent data that just came out from the United Kingdom shows that crypto scams are on the record high. If you look at the latest report, it shows that over £300 million worth of crypto flows happened in 2020. So these are things that really weigh on the market. But having said that, you need to look at interesting innovations across the space. We're seeing a couple of big giants like Microsoft, Deloitte going into the digital asset space. They're also trying to create their own blockchain. The gaming industry is also moving on. But with all this, you could really still point to the fact that regulatory and the case of fraud, as Binance really recalled yesterday, that they helped the US authorities freeze about 4.4 million linked to North Korea cybercrime. So these are things really putting some little cloud. But long term, Bitcoin is up more than 60% this year. You can't really bet against the bullish run in the long term. But right now, the correction has been long overdue.
Right, we always see that correction when there's a bullish run in most markets. But let's look at some other bullish news at this point. Another thing to look forward to, June 1st, you see Hong Kong there, they're releasing a new regulatory framework that will allow crypto retail trading in Hong Kong. And most investors are looking at this as bullish, for China, and most of those China tokens. So we're looking forward to that June 1st. But tell us about this whole regulatory framework from Hong Kong.
Yeah, I think it's a very good step. If you look at dynamics in the Chinese market, China happens to be the second largest economy in the world and definitely has the world's largest middle class population. So, if you recall, when the Chinese government banned Bitcoin mining and crypto-related entities, that had a negative effect on the market. But this seems to be a positive, turnaround. But it's still left to be seen because the body language of the Chinese government has always been controlled. So, investors are still really pricing in on how things will play out. But, with the framework coming out, it tells you one thing, that the asset class definitely is not going to be suffering from extinction. We've seen that the European Union is also regulating the asset. So we're just waiting for the Americans. But I think in the long term, I think this regulation will definitely help the sanity because, like we previously highlighted, the scams and the dubious entities taking advantage of the unregulated space are somehow put a dark cloud on the space. So this is a positive for market stakeholders because this will definitely bring in banks, will bring in other traditional financial institutions to take in the market and further prop up liquidity.
I know most investors in this market, they like to chase some new narratives. We've seen the meme coin narrative. That has, I don't know if that's extinguished yet, still happening at this point with most of those meme coins rallying. So with this whole regulatory framework coming from Hong Kong, are we expecting some kind of narrative from this for maybe China-related coins trading in the market?
Definitely. I think, the Chinese also has some authority in the digital space, the e-yuan, just like the e-naira space, definitely they will seem to put some collaboration and they also have some exposure in the NFT market. So definitely we'll see coins that have significant exposure to the Asian markets propping up, But having said that, it's still a bit tricky to see how these things play out in the long term. The Chinese are also trying to weaken the dollar domination with the dollarization and the BRICS formation with the Russians. So I think with the crypto market, one will be surprised to see how this will play out with all their agenda.
Right, all eyes still on King Dollar at this point. Thank you so much, Olumide Additional, financial market analyst.
Thank you for having me.
All right, let's look at other coins now. See, Lido Dow also on the top gainers counter, that's up 2.68%. So we're seeing a single-digit gains this morning. We don't see stable coins yet. When you see stable coins on the top gainers counter, then you know it's getting real in the market. Let's look at the top losers. We see Carver, that's been on a downtrend for a while now, $1.10, down 8.02%. We see Pepe, after having a great run, giving some great gains there. Meme coin season that's down 7.77%, giving back about over 50% profit at this time. ApeCoin, 7.77% down. And we'll see Phantom, DAG Protocol, 33 cents, down 6.97%. So it's a really bloody market, at this point.
It's not even Friday yet.
It's not even Friday. So let's see what happens tomorrow.
Don't worry. It's a comeback.
Hopefully.
Thank you so much, Ladi.
Thank you.
Well, that's it on the program today. Thank you so much for being a part of it. We do have a final one tomorrow, so you want to join us then. Will Ibong will be back at 1:30 to give you update from the world of business. I'll be during Business Incorporated. They should also give you the stock market report later tonight. But I'll see you tomorrow with a fresh conversation. You join me then. I'm in John.